Okay, so chapter 17 is talking about analysis of financial statements, and we want to talk about what we mean by analysis, what's the purpose of it, why do we do that, right? So generally, the reason why you analyze financial statements is to make some strong business decisions. That's important, right? So doing an analysis is going to help companies or managers or internal and external users to reduce any uncertainty with financial statements. You're going to be able to apply analytical tools to financial statements, and you're going to be able to transform data. So, of course, this is just giving you a reminder of the internal users, the managers, the officers, the internal auditors, the people that are on the inside of the company making important decisions. And then external users, of course, shareholders because they have invested money in the business, lenders because they've lent money to start or continue to operate the business, and the consumers, right? That's very important to make sure that the company is going to continue to thrive. So how do we actually build, or how do we do analysis? We have these ratios, okay? And the ratios are under these 4 blocks or building blocks of analysis. So we have liquidity and efficiency ratios, we have solvency ratios, we have profitability ratios, and we have market prospect ratios, and we're going to look at all of those individually. So information for analysis. Basically, these are the prominent financial reports that we use to do analysis. The income statement, the balance sheet, statement of stockholders' equity, statement of cash flows, and any additional notes that have been disclosed for the business. So how are we going to compare? You got 4 benchmarks is what we call. Benchmarks are like standards or factors that we use in order to interpret whether or not the company is truly going to make it. So we have intra-company, and in your book, I'm on page 689 and 690. But you have intra-company, which is basically the company comparing the financial statements to other financial statements within the company from previous periods, previous years. Then you have competitors. We want to compare what the company is doing as opposed to its competitors. And then you have industry benchmarks that we try to meet, meaning we're trying to keep up with everybody that's within that same industry. And then guidelines. The guidelines are basically the rule of thumb, what generally works, okay, are the benchmarks that we try to meet. So some tools we use for analysis. Yes, ratio is one of them, and I talked about those 4 blocks for ratios, right? But then we have 2 different analyses that we do for the financial statements. One is a horizontal analysis, one is a vertical analysis. The horizontal analysis is going to compare that business or that company's financial condition and their performance across time. So that means across several periods, right? And then vertical analysis is going to compare their financial condition and performance to a base amount, so maybe a previous year. Okay, so that's the difference. Horizontal analysis is going to be something that's going to probably look at historic information. So over a course of some years, if you're in 2015 now, you're probably going to look at 2014 and 13 and possibly 12 if you're doing a horizontal. If you're doing a vertical analysis, you're probably going to use a base amount, meaning if we're in 2015, your base is probably going to be 2014 if you want to compare from year to year. If you want to go previously, you can do a year before that. And then, of course, the ratio analysis, which we're going to dive into, is going to look at different items, different line items on the financial statement and compare them to make a justification as to how the business is doing financially, okay? This is an example of a horizontal analysis. Notice the horizontal analysis is over periods of time, right? This is just a comparative balance sheet. We're doing 2011 and 2010. We're looking at the dollar difference from one year to the next. That's that dollar change. And we're also looking at a percent change from the previous year to the current year. That's generally what you would get with a comparative horizontal analysis of the balance sheet. So comparative statements, calculate the change in the dollar amount. This is very important. If you're trying to calculate a dollar change, you're just going to look at the current year and subtract out the previous year. Okay? So analysis period amount minus base period amount is going to give you your dollar change. Anytime you're doing a horizontal analysis, you're going to have to look at the dollar change. Now, you're also wanting to look at the percent change. And that's going to take you using your dollar change that you calculated before and dividing that by the base period amount or the previous period amount. And then multiplying that by 100. That's going to give you your percent change. So dollar change divided by base period amount multiplied by 100 is going to give you your percent change on a horizontal analysis comparison. So look at what they do here. They're showing you how they got these amounts, right? Dollar change for cash and cash equivalents, $68,591. They got that from taking 2011 and then subtracting out 2010. So taking the current year and subtracting out the previous year gave them the dollar change difference. Then you know you're bringing that same $68,591 down and dividing that by the base, right? The base is the previous year, 393,927, and then multiplying that by 100 to get your percent change. That's important. Let me see if I can just here. So what we're basically trying to say is, what's the equation I just gave you to find a dollar change?
Analysis period.
Analysis period. Maybe I didn't want to do it. Analysis period. Subtracting. Oh gosh. Okay. Analysis period. Subtracting what?
Base period.
Subtracting base. So we got 325,336 minus 393,927, which gives us a balance of 68,591, right? And then we want to take.
I ain't in the motherfucking mood today, partner. I will cuss you the fuck out. I don't give a damn about this being no school. Laughing no child when they fall and kick them down.
Okay, those of you listening to that on the recording, I apologize for that. Okay, so then we take our dollar change and we bring it down here to find our percent change. And we're going to divide that by what? Base. This always goes back to the same thing. And multiply that by 100 to get our percent change. So everybody's clear about that, right?
Mm.
Okay. Okay, so now looking at a comparative income statement, because that's totally different. You got the same concept, right? You have your analysis amount, which is the current year, subtracting 2010, which is the base amount or base year, to get your dollar change. And then for you to find your percent change, you're taking your dollar change of that 665,810 and dividing that by your base year or base amount and multiplying it by 100 to get your percent change. So it's just a different financial statement, same concept. Now, trend analysis. The reason why we use a trend analysis is to look at patterns in financial statements, okay, over a certain amount of periods. So you have analysis period amount, you have base period amount, divided by the base period amount, multiplied by 100. That's still the same as what?
Percent.
The percent change that we did with the horizontal analysis, that's the same thing, same exact process. So let's look at that. If we were doing analysis amount divided by base amount and multiplied by 100, they're saying here that the base year is 2007. And our analysis year is going to be the current year. So if we start off with 2008, we're going to take that $1,948,254 for sales, and we're going to divide that by 2007 sales of $1,780,009 and multiply by 100 to get our trend analysis percent. Okay, trend percent. And then 2009, same situation. Use the current year's amount divided by 2007 amount, multiply by 100, and we're going to get our percentage, trend percent.
So the base year is always the earliest year when you.
Generally is the earliest year, or if you only have 2 years, the previous year. Okay, so they just grab that trend percent. Common size statements. So common size percentage, you can read about common size statements, but look at the equation. It's the same thing over and over again, right? Analysis amount divided by the base amount multiplied by 100. They're showing you the financial statements. And in a financial statement, if you're only dealing with 1 year, then that's what makes it different from the horizontal analysis. Remember how I said the horizontal analysis covers multiple periods, right? Vertical analysis is only covering 1 year, one statement, but there's still a base amount to be had. If you look at the balance sheet, total assets is going to be the base amount. What's going to be the analysis amount? Each asset. So it will be cash divided by total assets. Cash and cash equivalents divided by total assets. Accounts receivable divided by total assets. You get where I'm going with that? So let's look at it here. They're giving you an example. We're trying to find, we got 2 years in this case, and we're trying to find the percent, common size percent for each year. So if we just start off with 2011, which is the current year, total assets down there equal $1,228,024. So we know that that is our base amount. We want to see what does cash and cash equivalents percent out to as a, as a part of total assets. So we take our cash and cash equivalents for 2011 of 325,336. We divide it into our total assets amount and multiply it by 100 to equal 26.5%. The same thing with property, plant, and equipment. I'm not property, plant, and equipment. But looking for a 2010, same thing. Cash amount, cash and cash equivalents amount, 393,927 for 2010, dividing it by total assets for 2010 to get that percentage, and so forth. And you keep doing that for every single line item on that balance sheet. Okay. Now this is the income statement, totally different. The first one was a balance sheet. Now this is the income statement. So the base amount, what do you think the base amount is?
The 2010 sales.
2010 sales. Do you agree, Mr. Coleman?
Yeah. Or 2011.
2011 is your base amount? Don't look at the first line. The first line is always 100%. So don't look at the first line. Try the second line. The second line there is your analysis amount of the current year, right?
Yeah.
Of cost of sales, 2011, 1,916,366. And what are we dividing it by?
Base, which is the 1,460,900. Oh.
Up here in this first block, you're dividing it by 2011 sales. So sales becomes the base.
Okay.
You remember from, let's go back to that other slide. Here, income statement. This is important. Income statement, the base amount is always the revenues or sales on an income statement. For a balance sheet, it's always the total assets. So going back to this example, we have sales of cost of sales of 1,916,366. That's our analysis amount. And we're going to divide it by our base, which is always revenues or sales, for that same year. Okay, same year. 2,656,949. And then you have the next year for 2010 or the previous year. Your analysis amount is the cost of sales for 2010. Your base amount is still the sales for 2010. So you see how that works, right?
Yeah.
Okay. And they're just graphing that out for you there. So let's talk about some of these ratio analysis. These are the 4 blocks again, or the 4 categories, I should say, of the ratio analysis, right? And we're going to talk about each one of these categories individually. So we got liquidity and efficiency. The current ratio for liquidity and efficiency, the ratios for liquidity and efficiency are current ratio, asset test ratio, accounts receivable turnover, total asset turnover, days sales and inventory, days sales uncollected, and inventory turnover. And the pattern that you see in these ratios is that all of them deal with different items that are on the income statement. The balance sheet, I'm sorry. And the reason for that is if we talk about liquidity, what it means to be liquid means that you can easily convert your assets to cash, relatively easy, hopefully within 1 year, right? And that's why we use those types of ratios. So let's start with the most common, which was not mentioned there, but it is the most common, working capital. Working capital is current assets minus current liabilities. And so what this means is that, I'm sorry, can one of you do me a favor? So, all right, so working capital is current assets minus current liabilities equals working capital. So what does this actually mean? If the current assets are more than the current liabilities, That's a good thing, because that means that if in fact the business closes or they liquidate, then they'll be able to pay off their debt and they'll still have money left over to do other things. If the liabilities far exceed the assets, then that becomes a problem, because then that means that they don't even have enough value in assets to cover their debt, and they may be in the hole in the event that they have to close the business. Current ratio, that's current assets divided by current liabilities. All this means is that if they have more short-term debt, because that's what current liabilities are, um, it's going to have a lower ratio, meaning if current assets are much smaller than the current liabilities, same kind of situation, that means that they can't pay their short-term debt off. But if the current assets far exceed current liabilities, then that means that they are highly liquid, meaning that they have enough assets to not only liquidate, but have money after the fact to pay towards long-term debt. Asset test ratio, which sometimes they call it quick assets ratio, is your cash plus short-term investments plus current receivables divided by current liabilities. It is similar to current ratios, basically trying to make sure that current assets exceed current liabilities so that they can pay off the debt quicker. Also, to make sure, the reason why they incorporate short-term investments in there is to make sure that all of the cash and the cash equivalents, because short-term investment falls under cash equivalents, can easily be converted to cash. Accounts receivable turnover. This one is very important, and the reason for that is because you want to know how long on average it takes for a receivables to be converted to cash. So, for instance, if you know that you have 5,000 in receivables, and on average it takes you about 30 days to receive payment, it's pretty good. But if you have 5,000 in receivables and it takes you on average 90 days to collect, that's not that good, because obviously that's going to affect your cash flow, right? Inventory turnover. That's important because you need to know how quick it takes for you to get rid of your inventory. So it says here the ratio measures the number of times merchandise is sold and replaced during the year. If you have merchandise going out and its average turnaround is about 3 or 4 days, that's pretty good. That means as quick as you're making or purchasing inventory, that's as quick as it's going out, and that's pretty good. But if it's taking you 20 and 30 days to sell merchandise that you purchased 30 days ago, that may not be so much of a favorable inventory turnover. Days sales uncollected. This means for your accounts receivable, how often are the receivables going uncollected? Is still equivalent to your accounts receivable turnover ratio. But how many days is it going without you not collecting the receivables? And the reason that is important is simply because you want to collect receivables as quick as you can, at least within the first 30 days, so that you don't start to lose money. Days sale in inventory. Again, how quick of the ending inventory that you have, how quick or how many days is it taking you to sell that inventory? How long is the process from the time that you get the product to the time that it goes out of the door? That all of that affects cash flow. It affects operations. It affects sales. Total asset turnover. Now this is a relatively different and unique one, because we know that companies hold on to assets because they hold value, right? But in the event that they had to be liquidated, then what is the average amount of sales that it generates? Like for each asset, if you had a building as one of your assets, How long or how many days does it take that building to really generate sales? And I would go so far as to say, if you have a factory where people are actually making product, it might be sufficient that it should only take a day to generate sales off of that building, right? Because people are working in that building every day. That's how you have to look at it. If it's a piece of equipment, operating equipment, on average, how much in sales does that equipment actually generate? If the equipment actually produces a product, it makes product, then how quickly is that going to be put into place so that it can generate some revenue for the business? Solvency ratios. These are some of the most common solvency ratios. You got debt ratio, you got equity ratio, pledged assets to secured liabilities, time interest earned. All of these are dealing with the liabilities portion and the owner's equity portion of the balance sheet, right? Talking about liabilities, debt, and equity. So, debt and equity ratios. We want to make sure that we, in some cases, have more equity than we do debt. But there will be cases where you will have more liabilities than you do equity. And it's not saying it's necessarily bad. But in this case, with the debt ratio, taking your total liabilities and dividing it by total liabilities and equity is going to give you your debt ratio. And what are we trying to say with that? Basically, your liabilities don't exceed the total of liabilities and equities. And how is that going to help the business? We just want to see how much equity to assets you truly have. That's really what that is all about. The debt ratio and the equity ratio and the debt to equity ratio sometimes measure the same things. Look at the debt to equity ratio here. Total liabilities divided by total equity. If it's a larger ratio, then that means that there's too much debt. And it's going to be hard for the company to maintain more money from places like banks and places that give loans and everything like that. It's going to be harder for them to get that because they have way too many liabilities, which means that they probably have a problem paying back as opposed to the other way around. Time, interest earned, income before interest and taxes divided by interest expense. What is the main purpose of this ratio? To get not necessarily the interest earned, but what you're trying to compare or what you're trying to measure is basically with all your long-term assets, the loans that are going to accrue interest, the bonds that are going to accrue interest, things of that nature. How much interest are you really paying your long-time creditors, right? As opposed to, because think about it, when you pay interest, you're also paying along with that the principal back. It might be one of those situations where you're paying the interest throughout the year and paying the principal and everything at maturity. So you just want to know how much interest that long-term creditor is really going to earn, because we know it changes. It could go from one thing to the next the longer that the debt continues to mature. So we want to look at net income, and we want to add in any kind of interest expenses and also add in any income taxes. Because think about it, you probably got that loan before you had to pay any kind of taxes on your sales or your revenues for the business, right? And lastly, profitability ratios. Profit margin, return on total assets, return on common stockholders' equity. Those things are important, and that is actually talking about both income statement and balance sheet, because we're looking at the profit of a business. Just because a business has cash flow, good cash flow doesn't necessarily mean that they are profitable. So starting with profit margin, net income divided by net sales, okay? This is just basically showing how much income, net income, is being earned for every sales dollar that is generated. Return on total assets, again, how net income is impacted by the average amount of assets that the company has on hand. How are the assets being used? If they're being used properly, then a lot of net income is going to be generated from them. If they're not used properly, then that won't be the case. Return on common stockholders' equity. The whole purpose of a stockholder or a shareholder is so that they can also have returns on the investments that they make, right? So if they're trying to have a return on the investments that they make, we want to see how net income and the dividends that we paid or elected to pay out work into that favor. So take net income, subtract preferred dividends. Notice we didn't say common because we know the common people are the last to get paid. But net income minus preferred dividends divided by average common stockholders' equity. So you want to make sure that, or you're trying to figure out if the company is really, with the net income that they're earning, able to pay the stockholders and give the stockholders a return, or are they just holding on to it, or are they not making enough? Market prospects, you have the price earnings ratio and dividend yield. Now, the price earnings ratio is just showing that the company has the opportunity to grow. If you're taking the price that you sell per common share for and dividing it by the actual earnings that you get per share, that's going to give you your price earnings ratio, and that's going to show whether or not the company can afford to grow and possibly sell additional shares or possibly be at a standstill. Dividend yield. We know that this is all about the ability to be able to pay a dividend, right? Annual cash dividend per share divided by the market price per share. Obviously, if the market price is much lower than your cash dividends per share, then that might be okay. But if the market price share is way higher than what you would pay normally in dividends per share, that's not necessarily good, because that means that the shareholders are losing on whatever they have invested, okay? And in your book, on page 707, they give you this chart here, and this is all of the ratios that are in or are a part of financial analysis. We probably did not talk about every last one of them, but all of them are there. You need to at least have that in hand and in tow. Okay. Okay, so let's do these problems. First, we have quick study 17-2. That's on page 717. Using the following information for Tide Corporation to determine the 2012 and 2013 trend percent for net sales using 2012 as the base year. So we have these net sales for both 2012 and 2013, and 2012 is our base year. And in order for you to find the trend percent, you have to take your analysis amount and divide that by your base year. Analysis amount would probably be the current year, and then base year the previous year. So for, let's just start with 2013. So 2013, and your base year is 2012, right? So if your base year is 2012, and we're taking the analysis amount and dividing it by the base year amount, what's your analysis amount for 2013?
801,000.
Oh, 800,000 one?
Yeah, 801,000.
Okay. Even?
No, 801.
Okay. And divided by what?
453,000.
453,000. So what is your trend percent for this year? 177%. Good. And then for 2012, it's obviously going to be what? The trend percent is going to be what? Because wasn't 2012? Yep, 100%. Because 2012 is also the base year. Good. Okay. Next, quick study 17-3 says refer to the information in quick study 17-2. Use that information for Tide Corporation to determine the 2012 and 2013 common size percents for cost of goods sold using net sales as the base. So we're looking for common size percents, and we're going to do it for 2013. And instead of it being a base year, we're using an actual item as the base, which is net sales. Okay, common size percent. So for 2013, how are we going to find the common size percent? We know that net sales are our base, right? Is that what it said?
Yeah, so you use the cost of goods sold over for each year.
Okay, so for 2013, let's start there. 2013, and we're going to say net sales is the base. So for 2013, you're going to use cost of goods sold. What's the cost of goods sold?
300.
Okay. 887. And what are you dividing it by?
Your net sales is 800.
Okay. And that gives us a common size percent of what?
49%.
49%. Okay, what about 2012? What's your cost of goods sold?
134,088.
And we're dividing that by the base amount for 2012, or the base net sales, 453,000, which gives us a common size percent of what? 29.6%. Good. Quick study 17-4 says compute the annual dollar changes and percent changes for each of the following accounts. So in order for us to find the dollar change, we have to do what? What's that ratio I gave you?
Analysis minus the base period.
Analysis amount minus the base period. So looking at this grid that you have, you got short-term investments. And for 2013, what was the amount for short-term investments? And what about 2012?
234,000.
So we're going to subtract these two, right? And that's going to give us our dollar change, which is how much?
140,634.
And how are we gonna find the percent change?
We're going to use the dollar change that you got for manufacturing conversion divided by the base amount, which is the 234,000.
So dollar change divided by base, multiplied by 100 equals percent change. Up here in this case, our dollar change was the 140,634, and we're dividing that by what? What's your base again? 234,000, which and then multiply that by 100, which gives us what percent? 60.1. Okay, next is accounts receivable. How much was it in 2013?
97,300.
How much was it in 2012?
101,000.
So the dollar change for that equals how much?
Negative 300. 3,686.
Okay. Now, if we do our 3,636 divided by our base amount, what's your base amount? 101? 101,000 times 100, what percent did you get?
3.6.
And it was negative, wasn't it?
Yeah.
Wasn't it negative?
Negative
So it's going to be a negative 0.3.6%. Okay, last one is notes payable. Did you have anything for 2013?
No.
Zero. Did you have anything for 2012?
88,000.
88,000. So we know that the dollar change is 88,000, right? And there's no percent change. Okay, good. Next one is exercise 17-3. Exercise 17-3.
So we have the first the last one we are going to call negative 58.1%.
Well, what is the reason why we say there was nothing for you to calculate for the last one? Why do I say that?
We have we have nothing in 2013 and 2012.
Mm-hmm.
2012
What was your base?
It's 2012.
2012 was your base, right? And so when you divide your dollar change by your base, you're gonna get what?
That's why I said to the base 800.
Mm-mm. If I guess what I'm trying to say, 88,000 and 88,000 is what?
One.
One. You can't do that. Like there's no common size percent change with that, even if you multiply it by 100. So when you don't have for your analysis amount, when your analysis amount is 0, then we automatically assume that there is no common percent change because we know that you will be taking the base year and dividing it by the base year or the base amount.
But if you release a negative 88,000,
Well, it wouldn't be negative 88,000. Why would it not be negative 88,000?
right? I thought
Because look at the
like
years.
0 minus 88,000.
Look at the years though. You're going the opposite way. 2013 is the current year, right? And 2012 is the previous year. So you went from 88,000 down to 0. You didn't go from 0 up to 88,000. Exercise 17-3. Compute trend percents for the following accounts using 2011 as the base year. Round the percents to whole numbers. State whether the situation as revealed by the trends appears to be favorable or unfavorable for each account. So the way that we find the trend percent is by doing what?
The analysis divided by the base.
Analysis divided by the base. So you got sales, you got cost of goods sold, and you have accounts receivable. Analysis divided by base. Is that it? Multiply times 100 equals trend percent. What's the base year?
2011.
Okay. That's something to keep in mind. All right, so if 2011 is the base year, and for each one of those accounts, it was how much for 2011? If two, no, what we're saying, if 2011 are the base years, then that means that the trend percent for 2011 is going to be what percent? 100% for each one of these accounts. Okay, now that we got that out of the way, going up the ladder, looking at 2012. If you're taking analysis amount, which is 2012, dividing that by base amount for 2011 for sales, what's the amount for sales for 2012?
That's going to be 234,000.
Okay. What amount for your base year?
151.
So that means that your percent was, once you multiply that by 100, equaled what?
156%.
156%. And so you have to do that for each one of these. So just give me the amounts for cost of goods sold percentage for 2012 is how many, what percent?
For 2012,
Uh-huh.
159%.
159%. Accounts receivable?
169%.
169%. On to 2013. How much for sales?
168%.
168%. Cost of goods sold?
172.
172. Accounts receivable?
182.
182%. 2014.
180.
180%,
182,
182%,
190,
192%. And lastly, 2015,
199,
189%,
191,
191%,
201.
201%. Okay, exercise 17-5. Express the following comparative income statements in common size percents and assess whether or not this company's situation has improved in the most recent year. Round the percent to 1 decimal. So when we're doing common size percent, we are looking at sales as
The base.
the base. Correct. So you got 2 years here. You have sales, cost of goods sold, gross profit, operating expenses, and net income. Okay, so 2012, let's start off there. We know that for the sales, the common size percent is going to be what?
Base.
What's the actual percent?
100%.
100%, because you're using that as the base, right? And so what we're saying here is it analysis amount divided by base multiplied by 100? So let's just do cost of goods sold first, and the rest of them you do the same. But what was cost of goods sold 2013 amount? No, I'm sorry, we're doing 2012. What was cost of goods sold amount for 2012?
290,000.
290,800. And divided by what sales amount for 2012?
625,000.
25,000. So what's the common size percent for cost of goods sold 2012?
Um, 46.5%.
46.5%. All right. You mean 2013's cost of goods sold amount?
560,000.
560,300. And what is 2013's sales amount?
740,000.
Which means that the common size percent for 2013 is what? For cost of goods sold?
75.7%.
75.7%. So give me the rest of them for 2012. What's 2012 gross profit?
$53.4%.
53.4%. What about 2013?
24.3%.
24.3%. What about operating expenses 2012?
I give you that. 34.9% or 35%.
35%. Operating expenses 2013 common size percent
17.3%.
17.3%. Net income 2012
18.5%.
18.5%. What about 2013 net income?
6.9%.
So 7%. Okay. Last one, exercise 17-7. company's year-end balance sheets follow. Express the balance sheets in common size percents, round amounts to the nearest 0.1%. Analyze and comment on the results. So, in order for us to find common size percents, we take our analysis amount and we divide that by our base amount, which in this case, remember I told you it should be what? If it's a balance sheet, what should be your base?
Your cash, asset.
Total.
Asset.
Total asset. So, and if we were talking about the liabilities and equity, the base amount is going to be your total liabilities and equity. Okay. So for the assets, that means that we're taking the cash amount and we're dividing it by the total assets amount in order to get our percent. And actually, you know what? Let's save that one, because that's a lot already. I don't have no space for it.
It's the same process that we use in each.
Yeah, the same ones we've been doing up until this point, right? Let's try this. Let's quickly go over exercise 17-8, which is talking about current ratio and asset test ratio. So the current ratio is what, what's the equation?
Current asset divided by current liability.
Current assets divided by current liabilities. And so in this case, they want us to use exercise 17-7 numbers for all three of those years. And we're gonna take, since it's broken down into different assets, we're gonna have to add each one of what we feel are the current assets and divide those by what?
Current liability.
Current liabilities, right. So let's go through it and let's start with year 2014 and we'll go down to the older years. So we're trying to find the current ratio, which is current assets divided by current liabilities, right? For the sake of those, that balance sheet that you have there, let's just list out the current assets so you know exactly what to add. What do you have?
Cash.
You got cash,
Accounts receivable.
accounts receivable.
Inventory.
What is it?
Inventory.
Inventory. Okay. What else?
Prepaid.
Prepaid. Uh-huh.
The plant asset would be.
What's a planned asset? That's long term. That's not current. So looking at 2014 numbers, we got to add the cash amount for 2014, which is how much?
31,015.
Okay, plus what else? Plus AR, which is how much?
89,500.
Plus inventory,
112,500.
plus prepaid expenses,
10,700.
and divide that by current liabilities. What's your current liabilities?
Accounts payable.
Accounts payable. So what's your accounts payable for 2014?
109,900.
So that means that the ratio equals what? Calculate that. 31,000 plus 89,000 31,800 plus 89,500 plus 112,500 plus 10,700 divided by 129,900.
Gonna be 188%.
So 1.88 to 1 is how we express that. And what that means is there is 1.88 of current assets to 1 of current liabilities. What about 2013? What's the cash amount?
35,625.
Accounts receivable,
62,500.
inventory,
82,500.
prepaid expenses,
9,375.
divided by that same accounts payable. What's the ratio here?
Same.
Oh, no. Sorry, wrong year.
75,000.
What's the accounts payable?
75,250.
75,250. What's the current ratio for 2013?
252 to 1.
So 2.52 to 1. 2012, what's the cash?
37,800.
37,800. Accounts receivable,
50,400.
inventory,
54,000.
prepaid,
5,000.
accounts payable.
51,250.
So what's the current ratio?
2.86.
What's behind the 6?
The 8, so it'll be 287.
2.87 to 1. All right. Next, they want us to do asset test.
Ratio.
Now, what is the asset test ratio?
Cash plus short-term investment.
Cash plus short-term investments
Plus current receivable.
plus current accounts receivable divided by what?
Current liability.
Current liabilities. Cash plus short-term investments plus current accounts receivable divided by current liabilities. In this case, do you have any short-term investments?
No.
No. So you got cash and you got AR. And as far as current liabilities, you have accounts payable, right? So for 2014, what's your cash?
31,000.
31,800 plus your receivables. How much?
89,500.
89,500 divided by your liabilities, which is how much?
129. 129. 129.
Okay. So that means your asset ratio for 2014 is what? 0.93 to 1. And then 2013, what's your cash amount?
35,625.
Plus 62,500.
So 62,500, which is your accounts receivable, divided by your accounts payable, which is how much? 75,250 equals what ratio?
1.3.
1.3 or 1.30 to 1. 2012, what's your cash amount
37,800,
plus accounts receivable amount
50,400,
divided by accounts payable
51,250,
equals what ratio?
1.7.
What's the after the 1?
That is 1.72.
Okay, so 1.72 to 1. Good. And so,
es equal to determine the ratio.
hmm,
Last question is to determine the ratio.